Hi, viewers. We're back again this week with what's buzzing in the world of economics and finance. Let's jump right into it. During his first congressional testimonies this week, newly appointed Federal Reserve Chairman Kevin Warsh faced heavy criticism from lawmakers and investors for being stingy with information. Warsh intentionally adopted a strategy of strict policy silence, flatly refusing to offer forward guidance or reveal projections regarding future interest rate cuts. By withholding these critical details, Warsh signaled a deliberate shift away from the Fed's recent era of overcommunication, aiming instead to let markets react purely to raw economic data, rather than central bank forecasts. The final University of Michigan U.S. Consumer Sentiment Index for June 2026 rebounded to 49.5, breaking a prolonged decline and rising from May's historic record low of 44.8. This modest lift in consumer morale was primarily driven by a temporary easing in gasoline prices, which helped boost both current economic conditions and short-term household expectations. Additionally, near-term inflation expectations ticked downward to 4.6%, providing a slight reprieve for families squeezed by high living costs. However, overall confidence remained severely depressed by historical standards, as persistent anxieties over the long-term cost of living and a softening labor market kept a lid on any broader economic optimism. The second quarter U.S. corporate earnings season kicked off with a bang this week, led by historic results from the nation's largest financial institutions. Wall Street giants including J.P. Morgan Chase, Bank of America, and Citigroup widely beat Wall Street estimates, driven by an AI-fueled surge in investment banking fees, booming stock trading revenues, and stabilizing credit costs. According to early tracking from FactSet, an overwhelming 88% of S&P 500 companies that have reported so far surpassed their profit targets, putting the broader index on pace for a highly robust year-over-year earnings growth rate of over 23%. The fragile U.S. brokered ceasefire between the United States and Iran has officially collapsed, rapidly escalating into intensive back-and-forth military strikes across the Middle East. President Donald Trump declared the mid-June agreement over and notified Congress that the U.S. has returned to war, immediately revoking a 60-day general license on Iranian oil sales and reinstating a naval blockade in the Strait of Hormuz. The breakdown was triggered after Iran's Islamic Revolutionary Guard Corps, IRGC, allegedly breached the terms by attacking commercial merchant ships, which prompted heavy, retaliatory U.S. Central Command CENTCOM airstrikes against Iranian coastal infrastructure, highways, and logistics bridges. This sudden unraveling has sent Brent crude oil prices soaring, halted commercial shipping routes, and raised global alarm over the threat of a full-scale, uncontained regional war. China's economic growth slowed sharply to 4.3% year-over-year in the second quarter, marking the country's weakest expansion since the late 2022 COVID lockdowns and missing Wall Street forecasts of 4.5%. According to data released by China's National Bureau of Statistics, a deepening 18% crash in real estate development and an oil shock fueled by the widening Iran conflict heavily depressed domestic consumption and household confidence. While a massive 27% surge in high-tech manufacturing and AI-related exports managed to carry the economy to a 4.7% growth rate for the first half of the year, economists warn that the current model remains highly unbalanced. China's compounding economic woes worsened this week as new reports revealed that consumer loan defaults have soared to unprecedented record highs, heavily undermining Beijing's desperate push to revive domestic spending. Amid a bleak labor market and a protracted property slump, the total stock of household non-performing loans, NPLs, has swelled by over 20% to an estimated 2.22 trillion yuan, $324.5 billion, meaning roughly 1 in 10 Chinese adults have now fallen behind on their debt payments. To make matters worse, banking analysts from Moody's warned of a dangerous divergence where credit-worthy consumers are completely halting spending and cutting back on credit card usage, leaving desperate lower-income borrowers as the only ones actively taking on debt to stay afloat. The European Central Bank, ECB, is widely expected to pause its interest rate tightening cycle at its upcoming Governing Council meeting. According to economists surveyed by Bloomberg and Reuters, policymakers are opting to stand on the sidelines to thoroughly assess the economic impact of their previous 25 basis point hike in June. The decision to pause comes as Eurozone headline inflation moderated to 2.8% in June from 3.2% in May. However, with the collapse of the U.S.-Iran ceasefire in the Strait of Hormuz, central bank officials maintain that the pause is temporary. The Bank of Canada held its benchmark interest rate steady at 2.25% on July 15, 2026, marking the sixth consecutive time the rate has remained unchanged. Governor Tiff Macklem cited a rebound in economic growth and easing core inflation, though the bank remains cautious due to Middle East oil price risks and U.S. trade policies. For us, it is a confusing state, as falling unemployment rate and expectation of an economic rebound supports holding interest rates at current level, while core inflationary pressure affirms raising rates. The bank will have to monitor the inflation print for June to clarify the pass-through impact of the war in June. Most analysts expect inflation to narrow due to the peace deal, but there is a tad chance that inflation could flatline as the peace deal failed to last. As he prepares to take office as Prime Minister later this month, Labour MP Andy Burnham has signaled a radical overhaul of property taxation by advocating for a land value tax, LVT, and a proportional property tax. This move, however, has been questioned by analysts who claim that the UK already has one of the highest property taxes in the OECD. Our view is that UK does not need additional taxes, as the tax base is already stretched. Instead, Burnham's strategy should be to widen the tax base on which tax can be sourced. Analysts also note that while this wealth-shifting, leveling up tax would lower costs for roughly 75% of UK homeowners, it faces steep political resistance because the financial burden would fall heavily on high-value property owners in London and the Southeast. Reports confirmed this week that Japan has no immediate plans to overhaul the baseline target asset allocations of the Government Pension Investment Fund, GPIF. The clarification followed public remarks by the finance minister, who called on the fund to make substantially greater investments in Japanese financial assets, briefly sparking a volatile surge in the yen and domestic bonds. To cool sudden market speculation, government insiders clarified that the GPIF's core benchmark portfolio will not be modified before its next formal review. Instead, the $1.81 trillion pension giant can only legally increase its exposure to Japanese government bonds, JGBs, by leveraging its existing 6 percentage point permitted deviation band. This measured reassurance ultimately sent the yen sliding back down against the US dollar, as investors realized the fund will stick to strict investment discipline rather than acting as a tool for government currency intervention. Thanks for watching. Remember to like, share, and subscribe to this channel. And see you next week.